And good morning, everyone. John Hutchinson with Traders Reserve. Welcome to Breakfast Club on June 16th, Monday. Uh, Another week in the markets. Early returns of the market. Markets are rebounding. S&P up just about 0.5%, a little more than 0.5% here this morning. And I would expect probably positive recovery from late last week as news flow in general over the weekend wasn't any more or less negative due to the situation in the Middle East between Iran and Israel. It's worth noting as we get underway. I was just reading some of my sources, and market's not going to overreact to that situation for really a couple of major reasons. One, Iran not being a major player in the oil markets, and two, it seems to be largely confined to um, the two countries, so it has not escalated into a broader or larger regional war. If that should happen, that would change things. That would change the narrative around what's happening in the Middle East. But right now, market largely ignoring that. We have limited amount of economic data. Let's take a look quickly at the chart. So again, market's likely to open up above 6,000 again. So we'll see if we get another challenge to the 60-50 line. Largely held up fine last week, even though data was a little less positive, especially around weekly jobless claims, which continued to move slightly higher week over week, and continuing claims, which continue to move higher. Again, as I showed discussed last week, those are moving in upward trending channels, which signifies loss of momentum in the labor market, not a collapse of the labor market. So that is one of the things that we are watching as we go through the summer. No real major economic reports in and of themselves. Retail sales, but I don't expect retail sales to be significantly different than they were in April. And obviously the big day will be Wednesday with the Fed meeting. It is an FOMC meeting, so it is a forward-looking meeting where the Federal Reserve, or the FOMC, excuse me, provides their forward expectations for interest rate changes, the market pricing in two rate cuts, quarter point rate cuts throughout the end of 2025. I don't see any reason for the Fed to make any major changes from their March dot plot, so to speak. There's not enough data for the Fed to cut rates or raise rates or change their expectations for rates going forward. So I don't expect any major surprises. The surprise would be if the Fed cut rates, even if they cut rates by a quarter point. There's small justification for doing so, which is limited to stability, but losing momentum, excuse me, in both the economy and in the labor market. But nothing is at a point where um, things are so bad the Fed has to take action. And again, the biggest issue is what's the direct cause, and largely tariffs are driving that. Uncertainty is driving that. So I still don't see the Fed taking any action, despite the the inevitable social posting that will come Jerome Powell's way if they don't cut rates. But aside from that, still think September is the earliest point at which the Fed would consider cutting rates, which would give them really a full quarter in the second quarter, plus the start of the third quarter, to be able to assess any impact on the economy of the 10% universal tariffs. As well, we still have the July 8 or July 9 deadline for the reciprocal tariff deals, and an August deadline for the ongoing talks between China and the US. So there's still too much uncertainty for the Fed to take action. But nevertheless, any positive surprise, any rate cut would certainly be dovish and likely move the market higher. And then as we exit this week, we will be able to start turning our attention toward the 4th of July holiday and earnings season, which will begin directly following that. So most of the economic data should be a little quieter this week and next. And as we get into July, I think that's where we'll see the market really start to pay attention to what's taking place, both in the economy and across individual companies with their earnings. So that being said, leading sectors year to date. I'm going to talk through this just briefly because I'm going to do another stock screen for you today. We came up with a company that has a good looking chart and reasonable numbers. So we'll take a look at that here in just a minute. But it's generally, I like to look at a longer time frame to see where the changes are taking place in the market, in the sectors in the market. And this is the year to date, so we're coming up on a near full 6 months of pricing data, right? Stock pricing data. You can see utilities number two, probably not a huge surprise for two reasons. One, the extreme growth in utility providers to data centers, especially with the growth of artificial intelligence over the last 2 years. That is a key area sector that is worth trading, investing in as it continues to grow. And second, even though renewable energy has sort of been under attack, it's still a growth market. It still has long-term growth potential, even as automakers make changes to their plans not to go fully electric. Consumers are still choosing hybrids and electric vehicles, so there are still needs in that marketplace and desire, if you will. Right? People still want those types of options. Um, and of course, there's no shortage of potential opportunities for traders to find stocks in the utilities market that they can either hold for long term, great dividend plays, exist in that market, and or optionable trades, as we've been trading, for example, Southern, Constellation Energy, Vistra, uh, GE Vernova, a number of companies in the utility sector that we've traded over the last several months. But I was really surprised to see basic materials at the top. Now, 10%. In 6 months, nothing to write home about, but normally you would expect to see technology or communication services be in that top spot, and certainly consumer cyclical be somewhere in the top three. So it feels like the market's a little upside down here, and that's okay, because one of the stocks that I found doing my screen was in the basic materials market. Pays a small dividend. It's not. You're not going to retire on the dividend alone, but you can certainly add cash on a regular basis. So we'll take a look at that and how we got to that stock at the end here. I'm still keeping my eye on the consumer defensive versus consumer cyclical. Consumer defensive doing well at plus 5%. With all the uncertainty, again, not a surprise, but consumer defensive doesn't tend to be, those are your low beta stocks. Those are stocks that aren't going to have extreme movement in price, typically, unless something goes very badly wrong. But they're also not typically fast growers. So next week, we'll be taking a look at the cross correlation between consumer defensive, consumer cyclical, and where some trading and stock owning opportunities may exist between those two sectors. But for the moment, basic materials in the lead. The S&P 500 is back to positive for the year. So we will see how let's see how things transpire this week. Hopefully, relatively quiet week, and we can continue the trade closing ratio that we've experienced over the last several weeks on the positive side. So some excellent developments on that side of things. In fact, that brings me to this week's weekly income report. Take a walk through Income Masters, the Millionaires Trading Club. We just closed the last positions for the May Millionaires Trading Club and the May Income Masters events. So we'll give a quick update on those, and then a quick update on where we are with the SPX1 recovery trade, and then we'll do a stock screen. So let's get underway for the week. Last week, I missed. Should have been week ending June 13th. My mistake on this one. We closed our two final Income Madness trades. Over for the whole week, we closed 5 trades. The average time in trade was 12.4 days. Total capital for those 5 trades, rather, 12,122. Net income, $1,173, and a return on capital for the week of 9.7%. So very good week for Income Masters. Very busy week too. We opened 7 new trades. We went back to the well on GLD. That's the Gold Miners Index, on Meta, Albemarle, Eli Lilly, Netflix, Palantir, and IonQ. We added 2 new trades to our perpetual income positions in Southern Company, SO, and the BITO, the Bitcoin ETF. Excuse me, both of those were call positions. So those have, I believe, July expiration dates. So we will have those, hopefully be able to close those out in the next 2 weeks for rapid cash. And we rolled 5 positions in NextEra Energy, Domino's Pizza, Network Appliance, Costco, and Constellation Energy. So all in all, about 14 overall trades for Income Masters in the new trade, rolled trade category. So very busy week. I would expect something similar this week as we get more closer to our June 20th expirations, and as we start getting some movement in the market, either positively or negatively. I mentioned Income Madness. We closed out the Income Madness event from May 19th through 22nd were the trading dates. That was a Monday through a Thursday. We had 13 total trades over the four days. All 13 were successful trades, were wins. 33,661 was the maximum capital if you traded at scale based on the contracts Dave was trading. So that's 1 to 5 contracts per trade. Excuse me, 1 to 6 contracts. I believe there was one that was 6 contracts. Total income in the period or from the event, $2,147 in 21 total days from the first trade opened to the last trade closed. A 9.8 days average time in trade. I can say the vast majority of them, all except for the last 4, were closed in 2 to 9 days, and that helped get us some rapid wins. We have a 6.4% return on capital for the event. Nice, and that's consistent with what we've been achieving throughout 2025. We've had 3 Income Madness events so far this year in January, March, and May. We are looking at adding in our next one for July 2025. Total income year to date, 7,145. We do still have 1 position open in Costco, which is, I think, down to about a 45-cent debit. So may be able to exit that one at either a very small loss, break even, maybe even a small profit by in the next week to 10 days. But the average per event right now, 2,381, still averaging anywhere between 12 and 15 trades. Fewer trades when the markets are a little more volatile, more trades when the market is less so. For Millionaires Trading Club, we have 2 continued open positions, the Berkshire Hathaway B shares and the XOP, the Spider Oil and Gas. We added 4 new trades during our live trading event on Wednesday, June 11th, in the Russell 2000, the RUT, NVIDIA, GE, and Apple. Those have near-in expirations, so look for potential closes on those as we get through this week. We did close 3 trades, MicroStrategy, the S&P Index, both of those were from the May event, and Diamondback Energy, which was, I believe, a 2-day trade. We put it on Wednesday, and we closed it out on Friday for a $144 profit. So nice rapid win there. But for the week, we closed 3 trades, 18 days average time in trade, $8,600 total capital, $889 net income, a return on capital there of 10.3%. Finally, for the SPX1 trade update, again, a busy week. This week was different from the last two that I've reported on, in that the rolling action that we've taken between both the put and call spreads resulted in a net debit for the week of 10 cents or $10 per contract. But the benefit to that was twofold. One, we were able to close our put spread by the end of the week. So at the moment, we don't have a put spread on. So whatever transpires today or tomorrow, we may add another one or see how the market moves. But more importantly, we were able to move our call spread higher by nearly 60 points. You can see that on the right hand side. I got to get my little drawing tool out. I love this thing. So we were able to move our call spread up from the 58.40, 58.60 level to 59.00, 59.20. So we're closing the gap here with the market, even though the market will probably be somewhere up in here today. The objective is to keep trying to close the gap and or just get that one day where the market rolls over below our call spread. We can then close that one out either at a small debit or a couple dollar debit. We certainly have cash to play with, while continuing to leverage put spreads, generally somewhere in this range, to offset the cost of rolling the call spread at either a small net gain, net credit, or a small net debit. So that will be the plan as we go through the week for this week for the SPX1, but overall, still holding at 13.45 per contract, and that being able to roll that call spread up. We've picked up about 100 points on the call spread in the last few weeks, and since the huge gap up in mid-May, mid-May, that put that one upside down, not too far away. So we just hang in there, and we should be out pretty soon. So for the total week, 8 trades closed. We had net income of $2,062, $20,000 total capital across those trades, 10%, 9.9% return on capital. So a good week overall. And collectively, since we started Breakfast Club on May 27th, we've had 35 trades closed over the roughly 26-day period. A total income or net income of $6,735, represented by $93,000 in total capital, or a 7.2% return on capital in the time period. So overall, we're doing nicely. The starting date on that, roughly the 20th of May, I think we started closing trades. So I'm looking at pretty close to a month's worth of data, inclusive of the Income Madness period. And the Income Madness and the Millionaires Trading Club periods. So overall, a really good month for us, as we've not had, we really have not had any major negative influences in the market. Trading is moving along just fine. So with that, let me switch out to screening and give you an idea on a stock. Let's see. Change what we're looking at. So for this stock screen, and I'll use the annotation tool here just again for a second. Looking on the far left side, I have price over $20. I am looking at average volume over $500,000, 500,000 shares, excuse me. I'm strictly looking at the basic materials sector, since that is the leading sector so far this year. I want to follow strength in the market. USA, because I don't tend to follow foreign stocks. And on the fundamental side, hang on, clear those out. On the fundamental side, when I'm looking at price to earnings ratios, I'm looking at positive PEs. So that means that companies are already producing positive earnings, both in the trailing 12 months and in the forward period. When I'm screening between these two categories, it's not common for me to look at stocks that have negative PEs, in other words, PE below 0, because you're looking at companies that haven't made money, are not making money, or are losing money, any of those three types of categories. And I generally prefer to follow, again, strength. Companies that are growing earnings at a consistent rate are going to be more stable stocks, either as trading stocks or as investing stocks. Anything else is essentially the crapshoot kind of stock. Nothing wrong with those stocks. Those are more on the gambling side. So I prefer them more on the certainty side. That's my personal preference. One of the things that I am looking at right now when I look at companies, EPS growth next year over 10%. So the at the in the first Breakfast Club, I shared with you that earnings for next year are expected to grow by about 7% for the full S&P 500. So when I'm looking at sectors, industries, or individual stocks, I'm looking for companies that are going to beat the S&P 500's earnings expectations for next year. So here we're looking at 10%. That's at the minimum of 3% more versus the S&P 500. So that should have Wall Street's attention. And then finally, on the technical side, the last thing I look at that I'm looking at here in this particular sector are simple moving averages. Trading above the 50 and 200 day. I'm not adding a beta screen because these tend to be lower beta stocks. So adding beta just doesn't have a significant impact in weeding out or weeding in any particular company. So I just leave that one alone. So ultimately, what I came down here to were 7 companies in the basic materials sector. I would leave United States Steel Corp alone. That is driven by the acquisition that the Trump administration is allowing of U.S. Steel. Vulcan Materials has had a nice move up higher, but you can see it's channeling sideways. But it's also an expensive stock. It's not horribly expensive, but it is an expensive stock. It is worth looking at. But bear in mind, in the building materials category, you'd have to do, and we would want to do some research on the housing market, what's happening in the building realm, whether it's commercial building, is there demand? And if there's not demand, the stock might be running a little too hot for my taste right now. Steel Dynamics, basically in the steel market, again, not an exciting chart to me. Not a terrible company, but not an exciting chart. You can see their performance this year, pretty low, 6% for the quarter, flat for the year. So that's not really all that exciting. Royal Gold, not surprisingly, when I look at performance for the quarter and the half year, uh, the company is higher as gold has moved higher throughout the year. But it's also, notice there's no change. There's very little change between the quarter and the half year. So this might be a company that's run out of steam, and you can see that on the mini inset chart there. So it's channeling now sideways between roughly 170 and 190, but that's a tradable range, especially if you're options as an options trader, whether seller or buyer. That's a tradable range. It's not what I'm looking for right now, but that is a stock that you might want to throw down and come back to on your own. Freeport McMoran, copper provider. This is always a streaky stock. I tend to not like to trade the stock because of that. It's a highly volatile stock. I mean, this is one of those stocks where if I was using beta screen, the beta on this would likely be somewhere around 1 or 2. It is a very rapid moving stock up and down. You can get caught on the downside quickly. That's one reason why I tend to dislike it. Ecolab, worth looking at. You can see a breakout channel developing since the April tariff announcements. And again, an expensive stock. So between Vulcan, VMC, RGLD, Royal Gold, and Ecolab, those are 3 stocks worth investigating on your own for potential trading. But the company that I'm going to look at is Corteva. And you can see between Corteva and Ecolab, note the similarity in the charts. Uh, although Corteva has a more consistent uptrend versus Ecolab moved a little sideways in the early part of May, whereas Corteva just kind of gapped up and kept on going. So let's take a quick look at the underlying chart on Corteva. One thing that We were looking at this last week. You'll notice no crossovers on the 50 and 200 days. But you'll recall in last week's breakfast club, I pointed that out on a number of charts in the software sectors that we were looking at: software infrastructure, software services, et cetera. But the important point here is this. You'd have to go all the way back to last year to find a crossover, and even at that, it wasn't very long, and it certainly wasn't very deep. But that gives us some price stability. Well, gives me some price stability. Generally, consistent volume all the way down at the bottom. Earnings have been plus side on 4 out of 5 quarters. That's fine. I mentioned before, they pay a small dividend. It isn't much. Don't get excited. That's not a lottery ticket. A 17-cent dividend on June 2nd. So the next one, excuse me, will be paid in early September. The ex-dividend date, excuse me, should be early September. But you can see this company has some rising momentum. If we look on a weekly chart, you can see really from the beginning of 2024, the stock has been moving higher. Certainly some channeling sideways, but uh, definitely moving higher. And this is a relatively young company, 2019. And so you're still getting in, company 6 years old. You still have some potential. No, 6-year-old stock, excuse me. But you can see the last 2 months certainly breaking out to new highs. 52-week, that would be 52-week and all-time highs. So again, that's going to get the attention of mutual funds, hedge funds, et cetera. So those were some key factors in what I liked about this company. In the middle section here, I'll kind of rotate my mouse around it for a second on the left-hand side. Looking at some of their peers, DuPont, uh, DuPont not performing all that well. This is Archer Daniels Midland Farm Products. They've broken out recently. CF Industries, we trade CF Industries Inside Income Masters as a perpetual income stock. So we do trade a peer to Corteva. Agro, not sure that I would trade that one at less than $10 now. Plus, it's a Belgian stock, so not worth worrying about. Mosaic has had a similar run up since early April, but recently broke down. But Mosaic, generally an okay stock, but it's a lower priced stock. Not sure that it has the kind of momentum that we would be looking at. The last two companies were not worth worrying about on my side. We can see sales slightly declining over the last 3 years. I would like to see 2025 sales rising, but we can also see earnings bouncing back on the far left side from 2023 to 2024. We'll see what their full year, if their full year earnings are another 34 cent higher, as is expected, the company has certainly growth potential. Let's see if we got that. Go back to my forecast on this. Looks like this. Current price roughly 72.43. Earnings forward for the year $3.01. That's the 2025 earnings. The stock is currently trading at about a 17% discount to future earnings, forward earnings. I have a 1-year price projection of 98.05 based on their earnings and projections, and a roughly 16.5% 5-year growth rate, which would give me a 5-year potential return over 5 years of 114%. So the stock price could potentially double within the next 5 years. Doesn't mean it's going to take the full 5 years to do that, but that's where the potential is for this company. I will note, I did take a look at the options. They aren't there. The option chain is too wide. 5 point increments, number one. Too limited in actual volume and too limited in actual premium. Um, Maybe that changes as the company breaks the $100 mark and gets more volume, more upside potential. But as it stands right, and monthly options only. So there was not really a path for adding options, not even on the call side. So if you wanted to own 100 shares and sell covered calls, your choices were too limited in my view. Certainly, they'd be too limited for us as an options service provider. Um, As a stock, though, I think this company has good potential long term. So that's it for today. We had just a short week in data. We have a lot of trades open, so let's hope we can have some stability in the market, get a good clearing of the decks, and Jeff should be back with me next Monday with the next Breakfast Club, and we'll take a look and see how our performance was for this coming week next week. Thanks for joining me, John Hutchinson with Traders Reserve. This is Breakfast Club, and we'll see you again next Monday.